Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is Wednesday, November 12th. We have Joseph Wang, Ira Harris, and Judd Hirschberg. Joseph is known as the Fed guy, having worked as a senior trader on the open markets desk for the Federal Reserve. And Ira is independent trader, past hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003 and in 2019. And we also have Chief Investment Strategist Judd Hirschberg of White Wave Trading Strategies joining to help form the basis of some of the discussion with his charts and technical analysis indicators. Welcome, gentlemen.
Thank you.
Thank you. Thanks for having me.
Great. Joseph, I thought we'd begin with your global macro view on the economy and the financial markets.
Well, first off, I'm very surprised by how the U.S. economy has evolved. Heading into this year, I think there are two big forces that were, I think, pretty substantial headwinds for the U.S. economy. The first off, of course, was population growth. The president had a mandate to enforce immigration law, and so population growth this year was going to be a lot lower than prior years. Now, in order to have GDP growth, you can have basically GDP is the amount of goods and services a country produces in a year. The easy way to increase that is to just have more people working. And so when you had population growth over the past few years, that was a big contributor to GDP growth. And so if you had much lower population growth, logically speaking, you should have much slower GDP growth. The second headwind facing the country, of course, was tariffs. Now, tariffs have a very good public policy purpose, but at the end of the day, they are a tax. No one really knew what the tax rates would be. That was a kind of an exciting process where we all found out beginning in the Rose Garden in April 2nd. But now we kind of have a pretty good idea. Looking at what the data the Treasury is collecting, it's about $30 billion a month. So annualized, that's $360 billion a year. And that's a lot higher than it was prior to the Rose Garden episode. So I think prior last year, we collected about 90 billion. So from 90 to 360, that's a big tax increase. It's being borne by many people, shared among consumers, among companies, and among foreign exporters as well. But at the end of the day, it is a tax increase. So if you had a sudden shock in your population growth and higher taxes, you'd think that would be a significant headwind to the U.S. economy. And my expectation was that things would slow markedly. But, you know, the numbers we've been getting so far, at least, don't really seem to show that. And that kind of makes me a bit suspect of the numbers. And also, I'll note that we haven't had official data for some time. So it's hard to know how the U.S. economy is evolving. Consumer sentiment data that we get, anecdotes, for example, are that the consumer, for the most part, people don't feel too positive about the economy. You have a lot of retailers or restaurants reporting that you have less traffic. Chipotle, for example, was notable. So my sense is that the economy is slowing pretty significantly. And I think it's something that's going to become more obvious as time goes on, as we have more official data. Now, if you have, again, relying on the private sector data, you can see that labor market is definitely slowing. You see that in the recent ADP data, for example, on the weekly basis. And you can see that in challenger job cut reports and so forth. So, and of course, huge anecdotes that companies are cutting workforces. So I am thinking the economy is slowing and not doing that well. But that's a separate question from the financial markets and financial markets and the economy. We like to think that in theory, they're related through stuff like earnings. But of course, at the end of the day, financial markets it's supply and demand. And you have a lot of people buying stocks and other financial assets because they tend to go up. And you see that in a lot of corners in the markets and a lot of assets. We saw that, for example, beginning of the pandemic era, when you had NFTs and you have all these meme coins go up. You saw it when bankrupt companies like Hertz zoomed up, and you're seeing it today in basically stuff like crypto and uranium, all sorts of AI trades, which are probably in the long term, probably good companies and probably good businesses. But of course, it's difficult to see how their prices can be justified by conventional valuation metrics. So I think there's a lot of momentum, a lot of speculation in the markets, and that's what's driving it all the way to the moon. And I'm afraid that this could actually go off to some sort of blow off top. So we're in a mania. The economy is slowing. And so that tells me that the Fed is going to have to cut rates. And, it could be as was like a petit coup de whiskey and just kind of put that into overdrive. And that makes it quite dangerous. And that makes me worry about what happens after this comes down because so much of consumption seems to be what's holding up the market is the economy is just these wealth gains from wealthy people with stock exposure that continue to spend. And when that's gone, I think things will deteriorate pretty rapidly. So that's how I look at the world and the markets right now.
Mm-hmm. Yeah, good data points, very informative. And your thoughts, Ira, on that?
I'm not even going to go there. I mean, I want to discuss this with Joseph. So basically, when we come down to it, because I'm totally in agreement with you, where valuations by any metric, historical metric, are so stretched. But are they being stretched, Joseph? And you've sat in the room, so you know, or you've been close enough. It's not just a U.S. phenomenon; it's a global phenomenon because we know that fiscal stimulus is, if it's not in place already in Europe, it's highly anticipated. And now we have Tagichi
in Japan,
in Japan, and I read some things this morning, and the yen carry trade is a powerful element. For those who don't understand it, it's a powerful element because borrowing in a currency which you believe is going to be cheaper in a year, and the interest rates are significantly below where else you can borrow. Now, that doesn't mean you and I are borrowing there, although we probably have a better chance than a lot of others, but it does create that much more liquidity around the world. And I can look at the euro yen cross, I laugh at it. I go, are the Europeans that stupid? Because whether you call it currency manipulation or not, it results in far more liquidity around the world. And at the end of the day, when you're holding your rates down to fight a battle from 25, 30 years ago, because you fear the boogeyman of deflation, which is not certainly taking place. You're running Japan's running negative real yields, probably of about, for sure, 2%, maybe a little bit higher, maybe 2.5%. But do you see this, and will the Fed discuss this as fueling part of this? I'm not going to use the word, it's far from a mania, but it's certainly a bubble in the making. Do they look at that in the international perspective?
So the Fed just last week released their semi-annual financial stability report. And in it, they go through what they think about the asset prices. And, it's kind of suggesting that there's kind of everything is quite elevated, right? If you look at equities, you have your classical things like PE ratios, you have your equity risk premia. Those are all historically quite high. You look beyond that, look at house prices, quite high. You look at farmland, I think they're suggesting that it's around record highs when it's relative to the income that you can generate. Same thing in commercial real estate. It's quite elevated historically. So there's very much, I would say valuations are, according to the report, are historically elevated in basically all assets. Now, I think we have to be careful when we think about the Fed and asset prices because you and I, we and everyone here, we make our living off the markets. And so that's what we focus on. And we tend to think that that's what other people are thinking about all the time as well. But the Fed is very much about their mandate, full employment and price stability. So yes, they do see these asset prices. They know that they're elevated, but they also see that the labor market is weakening and they have to do their job. And so it looks like they are going to be continuing to cut into a time when asset prices are elevated. And I think that runs the risk that, what looks like the beginning of a bubble could become a full bubble. So they're definitely not pushing against it. I was listening to a very interesting podcast from Renaissance Macro a couple weeks ago or so forth, and a very, very good observation was made that usually when you have bubbles, when they're to pop them, you have the central bank pushing against that, right? You saw that in the 1920s. You saw that during the dot-com, right? The central bank actively raising rates, not necessarily to pop the bubble, but oftentimes bubbles coincide with hot economic conditions, right? During the 1990s, there was low unemployment, the economy was doing well, and so it's to target those and maybe partially, of course, to address asset price inflation. But today, though, you have the opposite. You have asset prices elevated, the economy, from what I see, weak, and the Fed about to continue to cut rates. And who knows, maybe they could cut a few more times, more than the market expects, even though we have a bit of a civil war there right now. So, yeah, I don't think the Fed is going to stand in the way of this.
So really, you presented as Bill White beautifully presented it back in, I think, 07 or 08. You were probably in kindergarten. But Bill White put it, do we lean or clean, right? When he was the chief economist at the BIS, that was the paper. And Greenspan looked at it that way too. What's the job of a central bank as you look at a financial, we were not going to call it a bubble. We'll use it a more Harvard term, potential financial instability.
Highly priced, I think, is what commentators say.
Right. So, do you lean or clean into it? And it's been an argument amongst many, because as long as the economy is humming and jobs are being created, why should the Fed step in? Except the cost of cleaning up the mess, so to speak, can be enormous, as we saw. I mean, we have recent history, 2008, 2000. I mean, we're still cleaning up from that, from the cleanup of the cleanup, and trying to understand where we're at. So I really like that you went there, because this is a global phenomenon. And now you throw the European fiscal stimulus package and now you have Japan and Takaichi, who wants to ramp up, especially military spending, to please Trump in the short term, although she got in trouble, I saw the other day, with her comments about Taiwan. Would it be an issue where Taiwan, if China invaded, would it be an issue for Japan? And everybody, as reported, has stayed away from it, but she went after it. But as Japan foresight uses the term, and I think it's absolutely right, military Keynesianism. And that's really kind of what's propelling the next wave. And again, it's not just Japan, it's just Takaichi, it's Korea, South Korea, it's Europe. And I'm not even talking about the cost of maintaining the Ukrainian war front and what's going on, certainly in the Mideast and Gaza and elsewhere. So there is a huge amount of stimulus, and it's you just look at global equity markets. The DAXs are making all-time highs today, but the Stoxx 50 is making all-time highs today, I believe. So you have all this liquidity pouring into the system, and we as investors and we as citizens are left. Does the Fed really take that into? Do they consider it at all in their ruminating?
I think one thing to note is you're totally right. We have this global equity, highly priced market, because in large part due to the fiscal stimulus, fiscal policy is pretty loose throughout the world. Now, I think the way that could flow into a central bank's calculation is, of course, inflation, right? So logically speaking, you have huge amounts of fiscal stimulus, deficit spending. That should be inflationary, and that should cause the central banks to, if not raise rates, at least keep rates where they are. I think what's kind of surprising to me at the moment is that you do have tremendous global fiscal stimulus. You do have asset prices very elevated, but inflation doesn't really kind of seem stable around 3% in the US. In Euroland, it's even more tame. In Japan, it is elevated, but maybe they don't care about that anymore. I don't know. It's actually higher than it is in the US. But inflation, at least in the US, I think there's reason to think that it could actually trend a bit lower. So I think that's the mechanism where asset prices and fiscal stimulus feed into the central bank's reaction function. We just haven't seen it yet. So I would watch to see if all this actually does eventually manifest in higher inflation numbers around the world.
I mean, in asking you these points, because you have such a good insight into it. I mean, they don't invite me to the as much as I'd like to get a seat at an FOMC press conference, but I'm sure it'd be a one and done deal. Because once I asked, actually I asked Powell a direct question in 2016 because he was in Chicago at the global, what used to be the Chicago Council on Foreign Affairs, and I asked him a question. And I was supposed to go to dinner, but I got disinvited after.
Next time you got to ask him, what's your secret to keeping inflation so low, sir?
Yeah. Well, I asked him a question. I asked him this question because we were talking. He wasn't the chair yet. He was just, a governor. And I did ask this question I asked, because it was a very hot issue at the time. I asked him, who guarantees the ECB? I said, they're pumping out all this liquidity in bonds via the bond market. Who guarantees them? And he, without blinking an eye, and I can go back and retrieve it, he says, they have a printing press. And, it was not a very good answer, as an investor, and especially that I do this I go, that's a pretty lame answer. Don't tell me they have a printing press. I know what that means, but then politically you're going to blow up all Europe anyway, because how long do you think the Germans are going to go with that? But that was his answer. And then I was told that I was no longer invited to dinner afterwards.
Wow, that's I've heard stories where they also kind of, don't like people who are even just very, very modest criticism. So it's I think that's not a good way to run an organization.
Well, he didn't invite me. The people who were sponsoring said, yeah. we don't ever, So I said, okay, whatever. But I really, because in talking to you about this, it's as close as we're going to get, because you have such a good insight and an eye on it, because you've been there. To know the mindset, and we don't get that enough. And and we always talk about the dual mandate, right? That's congressional dual mandate, and they really have a triple mandate, as we just saw in Argentina, because they were quick to open up those swap lines, and we saw that back during COVID too, in March of 2020. As they should have. I'm not criticizing for that. That's what they needed to do. All of a sudden, there's a dollar shortage in the world. You have to make sure that the system know that the Fed is going to provide the liquidity, and that's what they're supposed to do. But you can't just tell me you have a dual mandate. Then you have more, and that will bring us to. But we'll get there to where we're going to go, because nobody ever asked Powell that question. Like, do you keep an eye on the gold market?
The answer is no, for sure. I mean, people ask Bernanke that all the time too. Gold is an asset, is what he did say, actually. So
yeah,
no.
Yeah.
Okay, let's delve into that. Speaking of liquidity, I know you do a lot of research, Joseph, like on liquidity trends and the repo markets, repurchase agreement, lending markets, and just wondering if you see any trends, potential crises forming, or not only on a national scale but international, if you could.
So one thing to note is that I think the rules are kind of different today than they were in the past. I think looking for crises is going to be difficult, because there's such a strong willingness for people to paper over any problems, right? So we saw that during the pandemic. We saw that when Silicon Valley Bank went bust. Immediately you have new facilities papering things over, and not just that, they're willing that at that time they were willing to basically lend unsecured, right? If you had a treasury security trading at 80 cents, they'd give you 100 cents on it in terms of loans. So there's just such a huge willingness to do whatever it takes to avoid any instability. Uh, I don't, I wouldn't really be looking for crises. There are some things that are very difficult to control. I would say the currency is one of them. So that's where I would look for potential weak points. It doesn't seem to be worrying anyone at the moment. You see the dollar somewhat range bound, slightly strengthening over the past few weeks. So when it comes to the repo market, we do have, I think, more uh, kind of moderately more stressful funding conditions because we see that repo rates have trended higher and now are trading pretty regularly above interest on reserves. And what that tells me is that that corner of the market is running short on cash. And we saw this in 2019 as well. In 2019, September, we suddenly had the repo market basically explode higher. Rates were about 2.5% in September, and then boom, things exploded higher. At that day, it traded as high as almost 10%. So that's very unusual for a market that's usually quite sleepy and stable. Now, the repo market is the largest market you've never heard of. It's about, according to SOFR, about 3 trillion a day. It's basically just overnight loans backed by treasury securities, but it's also super important to the plumbing of the financial system. What we learned back in 2019 is that the repo market can sometimes run out of cash, and that leads to people who rely on that funding to totally scramble and pay whatever they can, whatever price to try to secure funding. Now, this is an important aspect of the post-Great Financial Crisis banking system. Pre-2008, banks were able to elastically expand their balance sheet and just create liquidity pretty easily. So you never had things like this happen. After 2008, because of much stricter regulations, banks are less elastic in their ability to provide liquidity. And so sometimes we see even very, very important markets have huge, I guess, temporary dislocations. We saw that in the treasury market in 2020, right? Treasury market was basically illiquid, and the Federal Reserve had to jump in and become dealer of last resort, expand their balance sheet, go and basically buy a whole bunch of treasury securities, which of course is taking securities out, putting liquidity back in, right? So this dealer of last resort function came back, was also seen in 2019 when the repo market ran out of cash. Fed stepped in and began to be lending cash into the market. So I think the fundamental problem is that the demand for cash in the front end is growing much faster than the supply of cash that can get into the money fund space. So every month, every day, you have inflows into money market funds. It's like 7 trillion now, continues to grow. That's your supply of cash that can be lent into the front end. But the demand for cash just grows much, much more quickly than that can be generated. The demand for cash, I think, is primarily driven by the fiscal deficit. It's $2 trillion a year. And that is ultimately largely financed in the front end. On the one hand, you have a lot of bill issuance, and the share of treasuries that are bills is increasing. But on the other hand, you can see that coupon securities are largely being on the margin financed by repo loans, which of course is borrowing in the front end. So that combination of bill issuance and higher demand for repo financing is just growing enormously. If you could see a chart of SOFR futures over the past 2 years, it's surprising. It's growing about $1 trillion a year. A few years ago it was 1 trillion, now it's 3 trillion. So that is just directly tied to the amount of collateral that needs to be financed. And as that grows quickly with the fiscal deficit, there's just, it exhausts the amount of money available in the front end, and you see rates go up. Right now, it seems like because rates are trading above IOR, you have banks being the marginal financiers. So banks, they have cash that sits at the Fed. They're called reserves. When repo rates trade above IOR, they also are interested in lending in the repo market. But ultimately, though, the bigger picture is that if you have a 2 trillion fiscal deficit, that's very rapid demand for front-end financing, and you're going to have the Fed step in to top up cash balances there. And so that's why the Fed stopped QT. And my personal view is that they're going to have to start expanding their balance sheet pretty sizably in the coming months, trying to add cash into the system to provide financing, supply of financing in the front end, because the demand is growing too rapidly. So some people are going to interpret that to be quite bullish. I know we have a lot of retail involvement now, and they think any expansion of the Fed balance sheet is positive, even though expansion occurs by buying treasury bills or something like that, which doesn't really impact overall duration in the private sector.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
You wanted to say something, Ira? Right.
Yeah. Well, so I mean, this is great because Joseph was walking through, and a lot of people think that they understand this and they don't understand it. But as he talks about the growing need for reserves for financing is because it's the government, right? And we're so when Marin and Bessent came in, they came in before they even got into official office. They were busy criticizing Brainerd and Yellen, and there was, believe me, from where I sit, there was plenty to criticize about. But they were criticizing how they, I would use the word, finagled the financing through front loading all that into T-bills. And they said they were going to end that, but they, of course, they've increased it by a lot. And I thought so when they go in and there's all these coupons, you call them coupons, more duration oriented, because from a trader's, that they have to be sopped up, right? And so if I'm earning a little bit more there on a repo, okay, I'm willing to do it. But at the end of the day, it's still financing the deficit, as you rightly point out. Where's this need coming from? It's supposedly a society where, well, everybody's in good shape. Where is this need for it? And it just continues to plague the system. I really thought that Bessent, because I'm actually in a book with him. There's like 10 interviews of global macro traders called Inside the House of Money by Steve Drobny. It was written in 2005, and they were all different interviews. And I've read that. And I met him once at the book launch, but more importantly, I went back and reread his chapter, the interview with Bessent, and it was very interesting, especially, he made his bones, of course, on the Bank of England, working for Soros and Druckenmiller, who I have great respect for Druckenmiller. But at the end of the day, I thought that he would be aggressive enough to take a failed auction to kick everybody in the teeth. Congress would get a kick in the teeth. The Fed would get a kick. It'd be a very dangerous road to hoe. But if you loaded up the coupons, walked away and load up, you were going to get a failed auction. I mean, even an idiot like me can figure out how to do that and to send the necessary ripples throughout the system. You have any thoughts on that?
Well, I think there was common thinking that, one way to get some fiscal discipline in Congress is to have the bond market wake up, the bond vigilantes rise, and that will change it. Now, that I think would be a very good market-based mechanism. But I think what we've seen over the past few years is that can be neutralized, right? It could be neutralized after the great financial crisis. It was the Fed buying trillions and trillions of coupons, right? If the Fed is buying everything, bond vigilantes just can't stand up and do anything, right? The Fed will buy it. And a past few, like you mentioned, during Secretary Yellen's term, when we had some when the 10-year was approaching 5%, a lot of the market was getting uneasy. They're just issuing more bills and fewer coupons, right? Boom, problem solved. And, that seems to even work in Japan. A lot of people were looking at the 40-year JGB rising, and the Ministry of Finance over there was just like, okay, we'll just issue fewer of them. And the market was, oh, okay, everything's okay. So they have the tools to manage the bond market. So I think that the wake-up call will have to come from the currency market, a substantial depreciation of the dollar. I think it just fundamentally, I think that makes sense because of all the spending that we're doing. But that's just not happening. I think maybe because other countries are kind of similar and probably economically not as strong. So no, I think the bond market is tamed. That's going to be under control. Now we did hear from the Treasury. I think last week they had their latest Treasury funding statement, and they're like you suggested, Yara, they're just going to keep coupon auction sizes stable for next several quarters. So that means though the share of bills is going to continue to increase. They're suggesting that maybe sometime in late 2026, maybe they'll think about adjusting coupon sizes then. But, I think that the broader strategy is clear. They're just going to continue what Secretary Yellen did and just finance more and more of the deficit on the front end. That takes away a very important market signal that I think would have alerted Congress a bit.
Mm-hmm. And just speaking of the Treasury, does it make sense now to add the QE from the Federal Reserve plus the sort of QE from the Treasury Department, like meaning we see the $2,000 stimmy checks, but also investments in rare earth companies and soon to be AI companies as well? Does that make sense to look at it collectively and the effects thereof? Yeah.
So I think the president has done something very, very clever. So fiscal policy comes from Congress. So you want to send checks to everyone, you need Congress to come and do stuff, right? You want to take money to give money to companies, you need Congress. I think they've found a way to kind of maybe sidestep this a little, because what they're doing is they're basically going to all these close allies like Korea, Japan, Euroland, probably Switzerland as well. We don't know the details yet, and saying that, I can put tariffs on you and I can take them off. You take all that money that you have earned through trade and you take that money and you invest it in the United States at my discretion, and, tariffs will come down. And if you look at a country like Japan, over the past few decades, they've earned a lot of dollars through trade. Official data suggests they have about $1 trillion worth of foreign reserves. In Korea, it's like, 350, 400, something like that. So in Taiwan is also a few hundred billion as well. So that is something that is completely done through the executive, through the discretion of the president. And suddenly he has access to all these funds that he can use to do stuff. And so maybe some of that investment is just going to be done through that way. If you add up all the amounts that are committed, it's several hundred billion. Maybe that won't materialize, but I technically think for the East Asian countries it will, simply because they depend on the U.S. for defense and market access so much. So I think there's a lot of creativity and a lot of leeway that this administration has exercised. And again, we saw that also in Argentina as well. Treasury had ESF, Exchange Stabilization Fund, just kind of creatively use that to bail out their friend Milei in Argentina. So even without Congress, I think they could do things to try to spend more money in the economy.
Okay. Good points. Yeah. Your thoughts, Ira?
Well, lots. I mean, this is great because we're really getting into the guts of some of this. First of all, Joseph, I agree. How the dollar sits up here is nobody's really paying attention, which is basically what you're saying, until they will pay attention. And with everybody else in the world cutting rates, if not now, but they have been. We have, European rates at 2%. We have Japanese rates. They need to go. Believe me, if I was running the BOJ, they'd be at 1.5% already, because the market's pushing it there on the 10-year, and it has been. So you're not going to escape from it. And other places, of course, the Canadians have lowered rates down to, I think,
And they have big fiscal spending there too. So they're like doing things that are kind of like the US actually.
Right, yeah. Again, so it's a global in how much stimulus that we're seeing. So yeah, a very, really good point. I just it's going to come somewhere where I mean it's in the metals already, unless you just believe that the metals are a spec, as Powell has said somewhere, and it was an interview with Sorkin. He said, and Sorkin didn't pursue it, but he said, well, he just views it like Bitcoin. It's just a speculative. But I think that's a grave mistake on the part of a central banker. But again, that's from where I sit. More importantly, all these things. So you said, like, if the bond market got into trouble, but would they run afoul, as Paul Volcker even warned when they did what they did back in the to bail out the great financial crisis? Will they run afoul of 13.3 of the Federal Reserve Act as to what they can really intervene on? Because when you start buying corporate bonds, which we saw them do when in 2020, in March of 2020, they were buying corporate bonds. Yes, they made money on them, but that's not the issue. What is the role of the central bank? And when they're always quick to talk about what their mandate is, and a mandate is a congressionally given role that you have. But if it becomes so flexible that you can do with it anything you want, you lose your. First of all, you're going to run into political trouble, and you're going to open yourself up to being attacked, and rightfully so. So I mean, all these things we talk about, and here we are, and nobody moves.
Yeah, it's going to be a political constraint, like you mentioned. What's written down in legislation that's not super useful. I mean, I don't think they ever anticipated that one day the Fed would help buy corporate bonds, but when you have the political will, you can do that. And the way they get around things like this is actually really interesting. So they just have a special purpose vehicle, have the Treasury put down some equity, lend money to the special purpose vehicle. And so if there's losses, Treasury would take the loss, then that covers the Fed, so to speak. And then on the asset side, just go and buy stuff. Back during the pandemic, they even had something called the Mainstream Lending Facility, which is trying to get loans to you and me. So ultimately financed by the Fed. So no, they're willing to do anything. You just kind of expand that Overton window more and more from the great financial crisis to the pandemic to today. If something bad happens, I think they will do whatever it takes, as another famous central banker said. Oh, in my experience also, I'll note that they don't care about gold or Bitcoin. Those prices don't mean anything to them. Like I would brief them about what happens in financial markets. And back then, at least, nobody ever wanted to hear about that. That was just, it goes up and goes down, right? Don't take any broader signal about perceptions about the central bank or the currency or anything like that.
But it's interesting that you say that, because back in the early 80s, and I've been trading longer than that, as Judd has, I know somebody who would, when Volcker became chair, who would buy his role. He had an official capacity, and he would have lunch every month with Volcker. And this is a guy who came out of the trading world. He wound up in his role, it was a state role in New York. And when he would have lunch with Volcker, one of the first things that Volcker would ask him is, "What's the gold price? What's going on what's going on in the gold market?" And Volcker, in my conversations with this person, and I'm going back 40 years of conversations, Volcker would say that gold, as a central banker, gold was his enemy, because gold would signal when they were really off, either fiscal or monetary policy was failing, or both, right? And we had that. And interesting, and when we go back to Japan, we return to Japan, under Reagan, when Volcker was busy raising rates, and again, forget the long end of the market, he squeezed the short in them because it was a Fed funds oriented market, so he could squeeze the funds. But real yields on overnight money probably went to 6, 7, 8%. And not for just overnight, like the French would like to do it when they were trying to protect the franc, but they stayed there. And that broke the back of inflation while we were getting, of course, fiscal stimulus out of the White House. Japan's doing it. So I would say that Ueda is anything but independent by holding rates, because he, as a responsible denizen of the currency, ought to be raising rates to at least a zero real yield. Whatever we're going to determine that is, we'll go to the Ira Star argument, but they ought to be raising rates and not walking lockstep. They're going to recreate the bubble of the Japanese stock market. They've learned nothing. So from 1989, I would probably say for 30 years for certain that they lived in that deflationary bubble. And as you talk about bond vigilantes, the one like myself who would be short the JGBs, as they rightfully called it, the widowmaker, because deflation had set in and people outside Japan truly didn't understand. They just saw all this easy monetary policy coupled with wanton fiscal policy, searching for a way all over. But the bonds never went down meaning the bond values never went down because deflation was. So if you were living in Japan, and even with interest rates at 50 basis points, you were still getting a real yield of 1.5% to 2%. We're not dealing with it. This is a different world. And if you're reading from that manuscript or playbook, you're just recreating the Japanese equity bubble is going to be recreated. If you run easy money as well as easy fiscal policy, you're looking for trouble.
Sounds like Japan's a goodbye.
Yeah,
one of the reasons that Ueda is just not raising rates is, it seems like Takashi Mei's comments just, the government doesn't want that to happen. So you see that kind of greater influence that the government has over the central banks. You see it in the US, of course, as well, but I guess that's a global thing. So one thing I'll add about Japan, and so they're like really advanced in the aging population thing we see all throughout the world. Ueda had this really cool speech at Jackson Hole a few months ago, and he had some charts showing that one of the reasons why inflation is so high in Japan is that labor costs are going up because we're running out of people. Like everyone is retiring, and so where are we going to get the people to serve the retiring population and so forth? And so he's like, at first we wanted to have women participate more in the labor force. That's all maxed out, and then we asked people to retire later, and that's all maxed out. And so now we just have wages go up. And so I feel like that's kind of a big macro story, at first to Europe, but eventually one day to the US as well. So yeah, so rates have to go higher. And if they don't, we're going to be, as you mentioned, Yara, we're going to have some wild rides in the markets.
Well, so let me ask you something, because we hear from the Fed all the time, but Powell said this, and a lot of Fed speakers have said this. Well, the unemployment data is a little bit softer because we don't have all the immigration, right?
Right.
But when I see that, okay, and I'm going back to your opening lines when we talk about GDP growth, population versus productivity. But if that was the case, okay, so we're not having that type of job growth because we don't have the immigration. In fact, we're going back. Ought there not be a quick, rapid rise in wages? Because you're still producing the same goods. I mean, the GDP, we haven't gone negative on GDP because we're still running. In fact, people say GDP is running hot. Where's the rise in wages? Because to me, if you have declining population in the labor market, and but yet you still have a growth. And now we have AI, and we have all these supposed investments that are going to come into the U.S. By the way, I'm not as convinced that we're going to see anywhere near those dollars, but Donald could dream what Donald dreams. But where is the? I think we should be seeing wage rises much higher than the 3.5%, maybe 4%. Where is that wage rise?
I agree. I mean, price is the tell here, right? You got changes in volumes, which the price is the tell. That tells us you're going to have the demand is quite weak, right? Labor market, even though we have population growth slowing, labor, despite fewer declining in quantity, at least in growth, can't ask for higher wages. So that really tells me that the underlying economy is weak. And that just makes all the sense in the world, right? Your population is just not growing that much. But how do you put up these GDP numbers? I don't get it. I think something's off here.
Yeah. Oh, great. I'm glad we got that. I was hoping, because you are so good with this, that it just hangs out there for me. And every time I hear them say, the job numbers are soft because of declining participation rates, I go, okay, but you're not seeing a slowdown in growth. There has to be a massive wage increase. Where is it? What am I missing?
Yeah. I think that's a big red flag. And so that's why though these good GDP numbers, honestly, I don't want to say that the data, I don't want to question official data and all that stuff, but I don't feel confident in it. So it doesn't seem right.
Okay.
Well, and I will say, while we're sitting here, Bostic just announced that he's not seeking another term as the.
It's gonna get a new Trump. Yeah. It's gonna be we'll put Bill Pulte there. We'll have him cut rates.
Oh, you know what? Not only does Bissett want to punch him in the face, I'd like to join in that game too.
I was reading that article about him going down to the golf course, showing the president a postcard being like, Franklin Delano Roosevelt, 30-year mortgage, Donald Trump, 50-year mortgage. And that's just beautiful marketing, really. So he knows how to speak to the president. And he's there's some hit pieces out on him in Politico. So yeah, he's making some people upset.
Yeah. Okay. No, that's given all these factors and trends. As a last question, just wondering your thoughts, Joseph, on the potential. Are we going to see like a repeat of the 1968 to 1982 type of phenomenon where you've got risk equity, maybe going higher, but not nominally, but not in real terms? So inflation adjusted or precious metals adjusted. Maybe it goes up a little bit, down a little bit, so factoring in all the liquidity, stimulus, US dollar trends, Fed and Treasury programs. Do you see that happening over a long period of time?
So I think that we should be in an inflationary period. I think so, simply because of the stance of fiscal policy, not just in the US, but globally. But so far, you just don't see that in the data, right? You see the economy weakening, and you see inflation stuck around 3%, probably trending lower. All the ingredients are there for us to be in a decade of higher inflation. Just hasn't materialized at the moment. I do think, though, that I think there's a couple of scenarios here. I think one is that, again, we have obvious bull market in equities, but in contrast to the dot-com or the 1920s, the real economy is not that well. And so we could eventually have a scenario where the AI bubble, maybe people become less enthused in it. I think the catalyst for that could be just competition within the ecosystem where, let's say, Google or Amazon have their own chips that are as good as NVIDIA. So NVIDIA, or great leader or great general, falls. Or it could be competition from China. In China, they actually have a very vibrant ecosystem. You have a billion people there, a lot of very good human capital, and a government that's absolutely determined to have a world-class AI system. And when the government there is determined, they built a world-class EV company, EV ecosystem out of nothing. And so they can actually do, I think they have a track record of being very good at that. So you could have competition from abroad, kind of like another DeepSeek moment that could also, I think, maybe pop the AI enthusiasm a bit. So that's possible. And if that were the case, I think we would just have a conventional recession, and then we wouldn't be worrying about inflation, and we'd be thinking about how to inflate this again. So we have huge fiscal stimulus, and that's basically printing dollars and so forth. But I think it's also important to realize that a lot of the wealth that in the United States, it's in equities, it's in these tradable instruments. And so even if we have tremendous fiscal deficits, printing dollars, printing treasuries, should we have a 30% decline in equities, that's going to have a very, very strong deflationary effect, because a lot of assets, a lot of wealth, a lot of money goes poof. And so that could lean against this fiscal-driven inflationary trend here. You could lean against it for, postpone it for some years. So that is a scenario there. Another scenario is that we just kind of go higher and higher. Eventually, the huge wealth effect just becomes so large, plus the fiscal spending, we do get inflationary impulses, forces the Fed to come in, raise rates, and then that could eventually, I think, pop it. So I think these are the kind of the two scenarios that I'm thinking that could play out.
Interesting. That's your thoughts, Ira, on those two scenarios.
That's such a great summation, because that's where we sit. And Joseph sees it through the plumbing and through fiscal, and everybody, again, can you time it? No. But so if I was looking for a play, and we'll come back to it, and so I certainly am not looking on a personal basis to extend my duration. They're going to pump a lot of T-bills into the system. Well, I'm going to look for things around those edges, but because whatever, the Bernanke doctrine, whatever reflects to me is this: the Bernanke doctrine is really simple. Bernanke made his bones academically on looking at 1937 and that famous, when he said to Milton Friedman at his 90th birthday party, "We'll never make that mistake again," meaning they will not allow deflation to set into the U.S. system. If you accept that, then, and Joseph and I, we're not saying that deflation is around or that type of event. And I'm not talking about deflation, just prices coming down through greater productivity. I'm talking about real deflation, especially with the elevation of asset prices. That's when you get into the quote unquote bad deflation, because prices start to drop, and people who are levered up cannot afford, do not have the ability to pay back. And we saw a quick little replay of it in March of 2023 out in Silicon Valley, between Silicon Valley Bank, Signature Bank, and of course the big enchilada was First Republic. And if that didn't make you a little bit nervous as an equity player, as well as just a regular everyday, person with some savings, then you're not paying attention. And the fact that First Republic stock dropped from $160, and it was the darling of people who really knew the financial system, to zero faster than I say a Tesla goes from 0 to 60. There's a lot to that. And I think that when Joseph talks, the underlying, this is not as strong as people want to believe. There's a lot of fragility here. And the fragility starts with the people who are supposedly coming back to work today, because they've done nothing. They've done nothing. And for myself, I would like to see a failed auction, no matter what it does to global equity prices, whatever. And as Joe said, the dollar will be probably the vehicle that goes. I agree with that. Because when they really have to start reacting to things that are just laying not deep under the surface, the dollar is going to have to be the element that gives.
Yeah, and maybe gold is one way to express that, right? I'm kind of surprised by how quickly it's rebounded after its hiccup.
Yeah, right now as we're talking, it's up $70. It's rallied $50. They must be listening to us. I'm sorry.
Yeah.
And silver's gone absolutely insane. So
crazy. Yeah.
So we're sitting there. Yeah. So again, for me, this was great. So,
yeah, it's been a great, insightful discussion. How can our listeners and viewers learn more about your work, Joseph?
Well, first off, they got to tune into every episode of this podcast. You guys have tremendous guests, and I really appreciate the wisdom that Yara shares. A lot of this, we see recurring patterns throughout markets. So having this historical context is really invaluable. So if you're interested in hearing more about my work, I have a website. It's called fedguy.com. Also on Twitter, fedguy12. And of course, thanks to Jude for showing the nice charts.
Great. Thanks, Joseph and Ira.
Well, I do what I do. I read what I read. And I actually been reading Joseph on X, which is, I don't go on X, but there's 3 people who I will read. Roman, Joseph, and Rudy.
Rudy, yeah, Rudy's great.
Yeah,
he came on your podcast, right? It was fun.
Yeah. We had him.
Richard was able to get him on. We actually had a good time with him. But that is it. There is nothing. I don't know how anybody could sit on there. It's, oh my God. Wow. But I pay it when Joseph, then I go searching other places because the Fed plumbing. And again, pay attention to Joseph. There are 3 plumbers in the world that I pay attention to in the financial world. Zoltan Pozar, James Aiken, and Joseph. Outside of that, because they understand markets as well as the plumbing. And I wish the Fed had more people who actually understood markets, because they don't want to, and it bothered me. That's why Beth Hammock, I thought, was a great pickup. And of course, Lori Logan, being that she sat at Soma for, they understand market, and they've been a little caustic of late. So I like that. Let's see where this goes. But Joseph's input was great. I love this.
Thank you. Very honored to be mentioned.
Great. And Jad, if you could put up your contact details. Yeah. If you can put up your contact details, Jad. Yeah. Thanks very much, Jad. And yep. Okay. Thanks, everybody. Thanks, Joseph,
guys.
Ira, and Jad.
Thank you.
Happy trading.
Thanks, Joseph. Great.
Bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.